So Jeff, now it's time to bring in our next guest, and we'll ask him a little bit about the difference between bonds and bond funds and that second problem, and that's Tim Sparks, founder and president of Sparks Financial Group, a retirement income store located in Lexington, Kentucky. Tim, thanks so much for being back with us on The Income Generation.
Thanks for having me.
Tim, it's great to see you all the way from Kentucky today. I've got a question for you, though. We're talking about here with inflation. And so the demand for fixed income, interest earnings, yields, and dividends has never been stronger. Are you finding that in Kentucky as well?
Oh, yeah. Yeah, a lot of people are looking for ways to, and, you know, of course, the way we market to the people here locally on the radio and stuff is investing for income, or what we call the burden of hand, where they can get, you know, a reasonable 4% or slightly more net to them each and every year, which, by the way, does keep up with inflation. They can do that with a balanced approach, so to speak, and they can have a mixture of, you know, stocks and bond-like instruments to do that.
And so what type of bond and bond-like instruments? Are we talking about corporates? Are we talking about ETFs, or a combination?
A combination, because, you know, depends on the, you know, the amount that's going to be invested in the, you know, more of the fixed instruments. They, you know, if it's less than maybe a certain amount, then maybe they want to be more diversified, more of an ETF portfolio that generates what we see maybe 3 times more in income than what they're in their current bond portfolios.
So in general, then, customers are telling you today that they're more concerned about income than they are about having money in stocks, especially for the ones that want to retire, correct?
Yes, correct.
So Tim, tell us, you know, if somebody has over $250,000, why should they go more toward individual bonds instead of bond mutual funds?
Well, there's 2 guarantees with a bond that a bond fund doesn't carry. And of course, it's depends on the default, but you know, bonds are generally going to pay, you know, 3, maybe 4% at best in our current portfolios, and they're pretty much going to receive that. That's a return on their principal, but at the same time, for the maturity period, whatever that period may be, 5 to 10 years, they get their principal back. Or bond funds, they do not get that.
Yeah, and once again, they have, at least the individual bonds also have a fixed income, which is in many ways the most important thing. And what other types of things do you like to sprinkle into these income-based portfolios? You know, we talk about bonds and bond-like instruments. So let's just cover some of those bond-like instruments for a moment, if we can.
Well, they can be, depending on the amount of, you know, risk they want to take from the stock side. It can be dividend paying stocks, maybe paying 3.5 or 4% at the best today, which is still an increase from what they're getting in their current funds or ETF portfolios, I see. But at the same time, we can actually, on the bond-like side, have you know, more of a preferred stock, or, you know, BDC, or even real estate.
Great, yeah, and those are things that are riskier on a standalone basis, but you know, sometimes the way it works with investments is you add a little bit of a riskier thing and you can actually lower the overall risk of the portfolio. Real quick, when and where can folks in your area listen to your radio show?
They listen to it on Saturdays at noon and on Sundays at 10 o'clock in the morning.
What station?
590 Talk AM.
I love it. Tim, thanks so much for being back with us here. We really appreciate it.
All right, thank you.